You know, one of the biggest challenges in any market is figuring out when a really powerful trend is about to run out of gas. If you get it right, you look like a genius. But if you get it wrong, well, you're the one left holding the bag. So today, we're going to break down the tools that can help you see a trend's end before it's obvious to absolutely everyone else.
Just take a look at this chart. You see this strong, clear uptrend in Treasury bonds. When you're in the middle of a move like this, it really feels like it's just going to go on forever, right? But every single person in the market is wrestling with the same question. How much higher can this thing really go? And more importantly, when's the reversal coming?
That is the million-dollar question, isn't it? How do you actually spot the top or the bottom before the rest of the market catches on? Well, it's not magic, folks. It's about measuring the market's internal strength, or what technical analysts call momentum. So, to get to the bottom of this, we've got to talk about that concept, momentum. The easiest way to think about it is as the force behind the price move. A trend can keep creeping higher, but if the force behind it, that oomph, is fading, that is a critical piece of information.
And the absolute best way to measure that force is with a set of tools called oscillators. I love this analogy. Think of an oscillator like the tachometer in your car. It's not telling you your speed. That's what the price is for. No, it tells you how hard the engine is revving. It's all about the rate of change.
So here's the key takeaway, right? Momentum is simply the velocity of prices. Is the trend speeding up? Is it coasting along? Or is it starting to run out of gas? Answering that question is the very first step to anticipating a change in direction.
Okay, so we've got the what. Now for the how. How do we actually use these oscillators to interpret what's going on? Well, it really boils down to three main signals that these tools give us, and we're going to walk through every single one.
These are the big three. First up, we'll see how they tell us when a market might be stretched way too far in one direction, what we call overbought or oversold. Then we'll cover what I think is the most powerful warning sign of all, divergence. And finally, we'll see how simple line crosses can actually confirm a new trend is underway.
Let's start with signal number one. Most of these oscillators are drawn inside a horizontal band. When that indicator line gets all the way up to the top of the band, it suggests the market is overbought. Basically, the buying frenzy might have gone too far, too fast. And the exact opposite is true at the bottom, which we call oversold. And wow, this chart just illustrates it perfectly. Look down there, in that lower panel. See how every time the momentum line hits that upper overbought zone, the price trend up top either stalls out or reverses? And the same thing happens when it hits the oversold zone at the bottom. These are the market's moments of pure greed and pure fear, mapped out for you to see. Okay, now for the big one. Seriously, if you take one thing away about oscillators, this is it, divergence. This is what happens when price and momentum start to disagree. The price might be making a brand new high, but if the oscillator isn't, that's a huge red flag. It's telling you the upward thrust, the energy, is weakening. And boom, here's a textbook case. See up top? The price is grinding out new highs. But now look down at the RSI oscillator. While prices are rising, see how the peaks on the RSI are getting lower and lower? That disagreement, that is a classic bearish divergence, and it's warning you that this rally is losing its internal strength. All right, our third signal is maybe the most straightforward of them all, the midpoint cross. A lot of these tools have a 0 line or a 50-level line right smack in the middle. A cross above that line can be seen as a buy signal, suggesting that positive momentum is taking charge. And, you guessed it, a cross below it acts as a sell signal, meaning negative momentum is now in control. Okay, so we've got the theory down. We know the signals to look for. Let's get practical and meet some of the actual tools of the trade. While they all measure momentum, you'll see they each have their own little quirks. Let's kick things off with a real popular one, the Relative Strength Index, or RSI. Now, the key thing to get with any oscillator is that the time period you choose really matters. See the 14-day RSI on top? It's much smoother, kind of a steady highway cruiser. But the 7-day RSI below is way more jagged and sensitive, almost like a zippy sports car. Shorter-term traders often prefer that extra sensitivity. Next up, we've got an indicator called stochastics. Now, I know that name sounds super complicated, but the idea behind it is incredibly simple. All it's doing is measuring where a security's closing price is relative to its high-low range over a certain period. That's it. let me put it in plain English for you. When a market is really strong and in an uptrend, prices tend to close right up near their highs for the day. That action pushes the stochastics reading way up, above 80. In a downtrend, prices consistently close down near the lows, and that pushes the reading below 20. It's a really simple but super effective way to gauge the market's conviction.
And finally, let's talk about the MACD. This one's a classic. You'll see it everywhere. It stands for Moving Average Convergence/Divergence, and as the name implies, it's built from moving averages. Its most basic signal is just a simple crossover. You can see on the chart, when the faster line crosses above the slower line, it's a potential buy signal. When it crosses back below, that's your cue to be cautious.
All right, so we've looked at the math, right? The pure mechanics of the market. But there's a whole other side to this, and it's all about psychology. It's about tapping into the art of contrary opinion.
This quote right here gets to the very heart of the idea. What does that really mean for us? It means that when everyone, and I mean everyone, agrees that the market is going up, you should probably start getting a little nervous. When sentiment gets that one-sided, it often means there's just no one left to buy. And this isn't just a feeling. We can actually put numbers to this. Look at this sentiment survey. See that bullish consensus line? It's at 77%. Now, your gut might say, great, everyone's bullish. But a true contrarian looks at that and thinks, if 77% of people are already bullish, who's left to buy? That extreme optimism is a warning sign. So we've got these awesome tools, right? Momentum oscillators, sentiment readings. But listen up, because none of it matters if you forget the single most important rule in all of technical analysis. It is absolutely critical.
And that rule is simple. The trend is king. Full stop. An uptrend is an uptrend until it isn't. Trying to short a powerful rising market just because one oscillator is overbought is like trying to stop a freight train with a fishing net. It is a recipe for disaster.
Remember, oscillators are confirmation tools. They are secondary. They are at their absolute best when they confirm what the price is already telling you. So, in that powerful uptrend we were talking about, you don't use an overbought signal to sell. No, you wait for an oversold reading to give you a potential buying opportunity, a chance to join the trend at a better price. You trade with the trend, always. So, there you have it. We've seen how to read the market's pulse, its heartbeat, and even how to get a sense of the crowd's emotional state. These tools can give you a real edge. But the final question is always the hardest, isn't it? Knowing what to do is one thing, but having the guts, the discipline, to actually do it, especially when it means going against the overwhelming feeling of the crowd, well, that's the real challenge.